Okay, hello traders, and welcome to this live intraday strategy webinar. Today is Tuesday, September 21st. Mike Boutros with you on the horn. We got the FOMC interest rate decision on tap tomorrow. We'll do a quick preview on what we're looking for in that release and hit the majors. So we covered most of these in yesterday's webinar. I hope you guys caught that on Daily FX. I will be live again tomorrow, Wednesday morning, as we head into the Fed. So for today on the menu, DXY, Euro, Sterling, Aussie, Dollar CAD, Dollar Swiss, interesting setup there, SPX, gold, crude oil, and Bitcoin. Take a look at what the crypto block is doing. So as always, questions, trade setups, feel free to throw them on the message board at any time. Let's jump right in. So for the DXY, yesterday we kind of fit the bill, right? We were looking for that pullback in the dollar index, near-term recovery in euro, near-term recovery in sterling. It's manifested pretty well, okay? But before we get into the metrics, I do want to take a moment and go over what we're looking for with tomorrow's Fed decision. So the last release we got, this was the June print, the Fed economic projections. We got an increase to 7% on GDP for the outlook for this year. That was up from a 6.5% clip in March. Unemployment's expected to hold the same. We saw PCE, the Fed's preferred inflationary gauge, up on both the headline figure from 2.4 to 3.4 and the core figure from 2.2 to 3. This is where the juice is going to be tomorrow. Okay, watch these two closely. And that's largely, I think, where we're going to get our catalyst. Okay, whether it's a tailwind or whether it's a real strong headwind for the markets, I think it's largely going to be on what the Fed sees with regards to inflationary pressures moving forward, and how that looks and how that's going to impact the dot plot, which is the other thing everyone will be looking at. So here's where we stood again back in June. You saw that no one saw any interest rate expectations for an increase this year. I don't think that's going to change. Okay, that's likely to stay the same. It's going to be what we're looking at in 2022. Okay, so you had 7 members at the last quarterly meeting suggesting that we may see a 0.5 to a whole percentage increase in 2022. And we're looking to see how this changes. Also, an interesting dynamic, and guys, when the release comes out, I'll post the comparison as I usually do, but we're also going to be looking to see if there's any change in the terminal or longer running rates, which haven't really shifted that much. But that's the backdrop we're coming into. It's all about, is the inflationary pressure exceedingly high? Is it more than just the transitory theme that the Fed has been preserving here, or is there something bigger amiss? So that's going to be what you're looking for tomorrow. And again, we'll go over this in the webinar and Daily Effects also, but something to take a look for. So where does that leave us on the dollar? Here's what the dollar index looked like last night. So top-down approach, you guys remember, we faltered last week right at the high week close. That was 93.45. Weekly chart doesn't have much on it. You're still in a pretty critical range. The daily charts are where things get interesting. So, you know, there's a couple of guys out there that I follow on Twitter, and some of my colleagues here in the city that are already starting to call this a head and shoulders formation. It's way too early for that kind of play, in my opinion. But as it stands, we've come into pretty big resistance. Okay, that's the November high day close from last year. It's the high day close for this year. We got slope right here as well. Okay, so we need this breach to mark resumption, targeting 93.70 and beyond. All things held constant, the play has been the risk for the pullback. Here's the first area of support. Here's what the intraday chart looks like. And here's what it looked like yesterday. So we did buckle back below the weekly open, 93.24. The 618 again comes in here at 93.04. Looks like we just tapped that. So where do we go from here? The objective, in my opinion, since the start of the week, again, just my humble opinion, is we're looking for a low either off this level or a deeper cut for just a clean 38.2 of the rally, which would still take you into trend support. Both of these areas of interest for possible exhaustion. Okay, now heading into the Fed, you want to stay light. You want to remain nimble. You don't want to really press any of these counter trend trades too aggressively. But certainly from this standpoint, I'm just looking for a low to fade. If we buckle back above the weekly open, this is still key resistance. So if you want to try the long, your stop needs to be against that low. But that's sort of the idea. Again, by my part, unicorns and rainbows. Ideal scenario, you see a washout tomorrow on the Fed, and then the dollar finds some ground, some footing. Bullish invalidation, I still have at the September open. So I'm going to need to see a break below the objective monthly open to validate sort of a reversal for the dollar uptrend that we've seen. Does that make sense? So that's DXY here. Maybe a little lower, but we're looking for some bottoming efforts here with a break above 93.45 needed to mark resumption. So that's the overall broader picture, guys. What we're looking for with the FOMC rate decision, what metrics to look for there, and the dollar price action. Before I get further into last night's update, I just want to take a quick roll in the previous night's update to hit euro. On the opposite side of this DXY, here's euro, picture perfect. Okay, so we started off the week saying, man, this thing is poised to open right above a key support confluence. You had a 38.2 of the advance, the objective March low, and 100% extension from the high. So if this is still just corrective, you'd expect to see some sort of bounce there, right? Here it is. Weekly open, drop right into that zone. You're already, what, 50 pips, 60 pips off that low. So the question being now is, it's the same scenario we're looking at with DXY. Do we get the extension into 1757, maybe even 1775? Look to fade that. Not sure, but I'm looking for that stretch to fade. At the end of the day, you need to close below 1694 to mark resumption. And if you get that, it's likely to be a dramatic sort of accelerated drop. 1660 is just a soft target, looking for 1621. All things held constant now, the risk is still for that lap, that pullback in the dollar, giving some alleviation to some of these majors in the US crosses. Any questions on euro? No change for any levels. If you're holding longs, okay, you want to start. I don't want you to start peeling off too much, but I would start to reduce exposure into the US Open if you start to fizzle into 1775. That's your first pivot region. It's the 618 of the entire rally, of the August range, essentially. So, I mean, 1780s would be the ideal clip, but I'd be cautious on the way up. Bring up your stops for sure to break even or better. Weekly open support usually works well on the breakout, but you haven't really gotten that blow off breakout yet. You know what I mean? And momentum's still holding 60 on the intraday chart. I'd be careful getting too aggressive on it. Okay, remember the bounce, guys, in this is the counter trend trade now, right? We broke, well, let me take a step back. Here's euro, go backwards here on the weekly charts. We bounced off, again, the low register just ahead of that level was the lowest 17 proper, okay, the 17 handle. 1694 is a 38.2. So again, you could see a scenario where you start to pop off a little, but looking for another drive lower, if possible, here in euro. On the daily chart, what's interesting is that this formation, which is a little bit different from what we have on the intraday chart here, has the lower parallel right here. There's that 38.2. As you can see, we just missed it in the little bounce. So on a closed basis, it essentially suggests we're still within the confines of this ascending formation. All right, so cautious here, cautiously looking for a low to fade for a little bit of a larger, better position for the long. Again, anything sub 1694, you're in real trouble. And it's interesting that all of these pairs, guys, are coming to these critical areas right as we head into the FOMC. So it actually might be a decent catalyst tomorrow. Any questions on euro? All right. So that was euro dollar back from the 19th. The other one we were following is sterling. I've reasserted this one after we broke. So remember, 137.12 was a huge region. It was the 618 of the rally, confirmed the break of the broader uptrend here. I threw this pitchfork on here into the start of the week to see if we can't get resistance at that confluence zone for a drive down to the 2021 objective yearly open. Here's sterling now. Too clean. Now, I missed this too. If you didn't get a chance to get in this, I don't, you know, I'm right there with you. There wasn't much of an opportunity to get an entry. There was no rally, nothing meaningful that we could fade. It just opened and plummeted. But where did it find support? At this key region. July low day close, the objective 2021 yearly open. There's the drop and hold. So again, scenario where if you see the dollar start to come off a little bit, sure, median line resistance max 37.35, possible entries, bearish invalidation at the September open. The one thing I've changed from this update, guys, on Sunday was instead of the 50 median line here, this is actually the 618. So if you double click on that, remove the 50 line, add the 618, gives you a nice fib support there, resistance, support. That's going to be where our bearish invalidation level is. Now, break on the downside for sterling would be, I mean, we're looking for that, but the break is likely to be accelerated if we do get it. Again, 36.25, 36.46, that key level. Just below that, it's stacked into 36, which is the August low, and the February low at 35.67. So be mindful of both of those levels. Let me just zoom it out for you. Lows, 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 all along the lower parallel here over the next couple of days. So major inflection zone here in sterling as we head into the Fed rate decision tomorrow. The following day, in case that wasn't enough, we get the release of the BOE interest rate decision from the UK. So this one's got uppercuts from both sides coming at it over the next 2 days. Stay nimble here. Again, my humble opinion, ideal scenario is to see a little bit of a rally to fade, but ultimately I'd love to see this buckle below 36.25, give us another downdraft there. Questions on the British pound? Number 3. All right, so Aussie, where does this leave us on the Aussie? Here's what it looked like into the start of the week. Again, I'll start from the top down here. Remember that from the weekly chart, it was a massive fake out, right? Remember we were talking about 73.28 for like months and months, broke below, completed a 1618 extension, and then just buckled right back above. Yesterday in the webinar, I was telling you guys to watch out for 72.48. That's near-term support for me on the weekly chart that converges right on that range, that slope range. So this is big support. Again, euro near inflection, sterling at inflection zone, Aussie approaching inflection here on the downside at 72.48. That's the weekly chart, right? So we're basically poised to put in a weekly doji as it stands right now. Here's what it looks like on the daily. Okay, so there's 73.28. Again, we buckled back below it last week and closed there. An outside reversal candle here on the 16th kept the downdraft into this key support zone. Again, former slope support. Current 618 of the rally from last month's low. We're there right now. Okay. Ideal scenario, bearish below 73.28. Break below here, you're looking for 71.85, and key support into 71.20, 71.38. That's the low day close for the year. That's the 1618 extension from the decline off the highs. Okay, but right here, I can't favor shorting it. Even if this breaks, it's likely to be a straight shot down to 71.85, but from a trading standpoint, you don't have a decent level. The only thing you can take around here is to stop against the high. And it's only Tuesday with major event risk on tap. But at the end of the day, man, what a clean formation, guys. This is the same formation we've been following since last week. Very, very tight. Here was the weekly open. Okay, we dipped down a little bit to that 618, just below it, rallied, and here's resistance again at that 100% extension at 72.76. On this one, I'm going to be as objective as possible. If the weekly opening range holds into tomorrow's event risk, look for a break there to give you the tell. So I got an itchy trigger finger on Aussie, and it's usually the pair that has the most itchiest trigger finger because I've traded this more than any other currency. But on this one, I think it pays to just be patient. The weekly opening range is preserved right above a nice lateral pivot level at 72.22. You're at downtrend resistance. If it pops higher, you're likely to see 73.30s, 73.40s real quick. Either way, would like a blow-off rally to fade again for the next leg lower. If we break the lows, again, likely to be a precipitous drop. 71.85 and 71.26 are probably be quickly on tap there. No Aussie data worth of note to close the week. So again, look for broader dollar price action and market sentiment to drive here. Here's what the daily chart looks like, by the way. Questions on Aussie? All right, that is number 4. Number 5, let's hit dollar CAD. Okay, so this one was pretty much in line with what we were talking about as well, right? The whole point, as we noted here on the 20th was, or yesterday, last night, was we're at resistance, okay? And it's a trigger resistance that has caused a lot of sort of tumultuous price action here. So you got the January highs of this year, which obviously we cleared already last month, but the close never got close. We ripped into that yesterday and looked to be closing right below the high day close for the year. Okay, again, it's the same trade. The risk is for the exhaustive move lower. Now, by dollar CAD's part, it has made a breach of the monthly opening range. So I do think that the broader focus is still looking for a late month high. But as it stands last night, it looked like it was a little tired, ready for a pullback. Here's what it looked like on the intraday chart. Confluence resistance since the January highs. If we take a slope off the low here, the parallel converged right there. Look for a little bit of a pullback was the name of the game. Right? Here's dollar CAD as it stands now. Right at that 38.2. Okay, 27.42. That was the exact low. Too clean for comfort. I'll also bring your attention that this is also the objective weekly open. So again, off key confluence resistance, we're now at support. Hey, Steve, says, sounds like there's an audio issue. Is that happening again, Steve? I'm so sorry. Bear with me one moment. Hey, Steve, is it better now? Are we good? Yes. Okay, awesome. Yeah, I apologize about that. Not sure what the deal is with the tech issue, but we'll see if we can't get that resolved. Good to go. Right on, Steve. So for dollar CAD, watch this region, right? The weekly opening range is set right below uptrend resistance. Take it as objective as you can. If the weekly opening range breaks lower on the Fed tomorrow, this is your salvation or nothing. Okay, it's 2021 yearly open objective critical level major pivot in price. The 50% of the rally converges on uptrend support. So objectively, if we duck and close below that, you're essentially marking reversal. Okay, and this is 2 equal legs up, so that would be concerning for me. But that's sort of the game plan here for dollar CAD. The dollar exhaustion story is still on tap. The objective play here would be probably the break lower, but we're looking for a fadeable event into uptrend support. Questions on Loonie? All right. Quick note on dollar Swiss. I actually don't have positioning on this, but I wanted to show you guys. It was the quintessential exhaustion trade, and it was very similar to what we just saw in dollar CAD, right? So before we get here, let me just get you the weekly charts real quick. Here's first dollar Swiss on the rally, right into objective median line resistance. Can't make this stuff up. On a closed basis, a stab right into the median line. That's a clear rejection. That's a clear rejection. So at the end of the day, we just came off of big uptrend resistance. What does that mean for the daily chart? Again, a little bit different of a take here, but the measured move is 2 equal legs off the high. Failure at 93.26. This was your breakout zone, key resistance 93.67. So what are we doing with this pullback? All things held constant, you're still in the uptrend, but you failed at major lateral resistance. So right now, the focus is on this downdraft for dollar Swiss heading into the FOMC tomorrow. What does that mean? 91.12, 91.13 is going to be a basic 38.2 of the advance. It converges on former upslope support. So here's the pitchfork that we were following last week. That break ripped. That's exactly what you want to see on a breach of uptrend resistance. But the hold at the 100 and the buckle back below, that's your quintessential exhaustion. So yeah, I do think there's some more downside to go here, and that's kind of in line with dollar taking a little breath, a little exhaustion, right? So something to take note of there on dollar Swiss. I don't have any positioning on this, but looking for a low, looking for a low. Quick note on SPX. I gave you guys an update on this, and again, the levels. So by the way, levels for Swissy, no change on those. But the levels just seem freakishly clean, right? I showed you guys this chart yesterday. I tweeted this chart in live time as the market was starting to rip lower. But two things I want to take into account first. Here's your weekly chart for SPX. Okay, that's not an outside. I was thinking that was an outside reversal, but it wasn't. Point is, it's your first momentum break below 70 that you've gotten, essentially since the hiccup that you had back here in June. And it's the deepest cut in momentum that we've gotten since January. Just a study on Momo, okay? This week's close will be paramount. If we are able to close above this slope, it's just a tail below slope support. If we close below that slope, that would be suggestive for a deeper correction in stocks. Again, not the popular commentary, but I'm not here to give the popular commentary. We're here to give what the technical outlook looks like. So here's what the SPX looks like on the daily chart. If we take a more objective look of just this year's price action, here's the dominant slope. That slope is parallel, caught support, parallel, support, 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 parallel, resistance, 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 raised ceiling, turn right ahead of resistance. That's a break. That's a break. So the question becomes, how deep is the correction if we have more to go? Well, the first major level that we had highlighted yesterday was 43.34. That was the 618 of the entire July rally. That was also the 100-day moving average. Add some sugar on that. It's also a parallel of slope resistance, extended off of these three lows, slope support. We closed well above. We closed well above. Now on this drop, a 38.2 gives you 4,400. We're there, or we tested that already today. Bearish invalidation is up at 44.57. Okay, so even if price rallies all the way up to here, you're still at former trend support turned resistance, current operative downtrend resistance, major Fibonacci resistance. That's the game plan here for SPX, guys. If this rally, we're at resistance right here, looking for a reaction. But if this rally is even further, the point is you're at risk below 44.57, and a break below 43.34 opens up a much deeper, steeper decline towards 42,045, 42,071. Look for a bigger reaction there if you get it, because that was a huge pivot on the way up, likely to be so on the way down if we reach that. Now, I recognize we're coming into major event risk. I recognize there's a lot of tailwinds. The markets are looking at a whole barrage of headlines, guys, whether we get the infrastructure 3 point whatever trillion that the Biden administration is trying to pull through, what impact that'll have on inflation, the Fed over the next 24 hours, we're going to get a whole outlook with their projected forecasts and the commentary. And you're basically looking at, some contagion effect from this Everglade thing in China, which everyone seems to talk about. So what I mean is there's a lot of things that the market's digesting over the next few, I guess I want to say into tomorrow, right? Wouldn't be too surprised to see some sideways, if not higher price action, but we're not out of the woods until we clear 44.57. Okay. And if this was a washout, again, when you look at the washout that we made yesterday in stocks, it looked pretty thorough, right? You had like 90% of all stocks, of all trades on the short side or closing out or selling. So it had high volume behind it, right? So it could be that that's the washout and the low is registered. It could be an event where it's just like this and we're off to the races the following day. But we have event risk on tap with the Fed. I think that's going to be the tell. All things held constant, below 44.57, you're at risk. Downside break beyond here, you're looking for 42.70 and 42.45. Okay, that's the daily chart. Here's the intraday. Little messy, but proves the point. A little bit different of a pitchfork that we've been following here. That's a clean break. It's a clean break. All right, so that is SPX number 7. Take a look at gold. So here's what the gold trade looks like. A bigger washout than anyone expected, I think, but it came in some big support. So remember, into last week's close, the region that we talked about, I'm just smiling because I didn't even see this recovery here, was 1747 into 1738. You had the 618 of the rally off the low. And then this is just a basic pivot. It's the stretch high you made in April, but a really nice pivot in price, right? Takes the lows that you made back here in June. Obviously, this August stretch, here we are. So on the weekly standpoint, we're sitting at a pretty decent pivot for gold, objectively. What does that mean on the daily? Boom. There's the June low. There's this year's low day close. My problem with this recovery is where it's recovered from. I would have loved to see a deeper drag into this zone, just for some symmetry. And there's a whole bunch of stuff I'm looking at there. But at the end of the day, here's the initial rebound. Here's the near-term chart. And here's what it looked like on our last update here. Oh, right here. So this was from the 16th. We were heading into the June low, 1750. We said, watch out. Big stretch. It's downtrend support. If it rebounds, near-term resistance is 1774. Bearish invalidation was at the weekly open. I didn't change any of the levels. I left them here just for reference, right? So here's the 38.2. We just turned right ahead of it. There's slope resistance. Last week's close, or last week's open rather, I'm not going to really stress that at this point. And the reason not is because if you bring this retracement up, just show you why, the 50 is basically right there. So whether you're looking at the 50, whether you're looking at last week's open, whatever, we're basically, it's the upper parallel. If this breaches, more focused on a rally towards 1795, towards 1798. So more something like this. Key resistance is right up here. Not out of the woods yet in gold. Not out of the woods yet in gold. And one other thing, I don't want to get too granular, but if this is a 5-wave decline, if we talked about the possibility of that being such, if this is going to take the stance of 2 equal legs before the rip lower, look where that 100 comes in, 1782. Okay, so if this is corrective and the 5-wave interpretation off the high is there, that's where the rally should max out. Okay, broadly speaking, again, on the longer term picture, guys, I am constructive gold. The whole ball game here is, has the pullback from resistance completed? And basically, because of where we are in the dollar, I think that's where I'm a little bit more cautious here. The dollar pullback, great, matches real well with the rally here. Push a little higher towards 1782. But if this breaches, that's likely on the other hand of the dollar kind of faltering, right? So for now, looking for an exhaustion high into 1782. 1777 is the first level, but 1782 is sort of the cherry pick. Make sense? Whew, look at that. Not bad. Not bad. Gold levels for you guys. Number 8. Okay. Moving right along, crude oil. Let's keep the commodity block in focus. Here's what oil looks like. And this thing's getting a little messy, but I think it's to be expected. So here's oil on the weekly charts, right? We talked about the breach above the 618 extension, retracement rather. Former slope support turned resistance, lasted for 3 weeks before last week we closed above. This pullback has me a little, I don't want to say confused, but has thrown me off a little. Like, if that close was legit and we buckled back above 71.13, honestly, if we close back above 71.13, I'm still bullish for the resumptive move. But this could be a failure if we close back below. So the weekly chart's giving me that seesaw. Well, you're at a big pivot. You closed above, you should technically still be constructive. So not sure how to approach this. Here's the daily chart, right? It needs to hold support right here, right now. Okay, here's your 236 basic retracement. Basic slope support off the low. 3 touch yesterday made this a valid slope. You know, if this is going to hold, I'd want to see this hold support today. Top side 73, 74.20s and 74.90s is critical. And then onto these extended targets. But it's all whether this pullback completes here or whether we get the deeper draw towards the monthly open. So the 38.2, which is your more significant proper fib, comes in just above the monthly open. So 68.48 to 68.76. That's like what the risk would be if we break below this slope. So for crude, I think it's make or break here. If it pivots lower, here's what it looks like on the intraday, right? Here's the level I was just talking to you about, 38.2, September open. That'd be a really nice zone to find a little bit more of a meaningful support bounce, because the break of the uptrend looks kind of messy here. I don't know what to do with that. So ideal scenario, it breaks lower, it gives you the exhaustion into 68. If the dollar just starts to rip, be careful, because if 68.76 breaks, I think you see a massive washout. Again, every time we've crossed through this region, it's only take a couple of times. So I'd be cautious with that. But at the end of the day, looking for a low in crude. Looking for a low in crude. No change to any of those levels. Here's what it looked like on our last update. We were talking about resistance right there. Ideally, we were looking for a last stretch into that 2011, 2018 high we closed, but that was the top. Pullback, we're at slope support. All right, so that is gold and oil. Okay, last but not least, Bitcoin. So it's been a pretty radical ride, and I wanted to show you guys just how effective, you know, the Bitcoin price action has been. So I did an interview yesterday with Barron's. They were calling about the Bitcoin move, and they were saying like, hey, you know, what do you see happening here? Is this a major flush or what's going on? And they published that one yesterday. You can actually go find it. But the commentary I gave them really had to do with what we've been following here, guys, for the last couple of months. So the 2018 parallel right, was a little bit off in time, but it suggested, again, this whole rebound off the low was still rather vulnerable. Last week, we closed right at the monthly open. So you were basically in a monthly doji. Yesterday's break was important, okay? Not only did it break multi-month uptrend support, but it broke this month's opening range lows, and it closed below the 38.2. And as I was saying yesterday, this is likely to be very noisy over the next couple of days. I do think, humbly, you're still at risk for one more scratch into a new low. The 100, as you can see here off the high, validates a move towards 38,777, would certainly be a nice area for possible entries. And these were both the levels that I talked yesterday with Barron's about, whether it was 41,929 or whether it was 38,777. Both of these levels, I think this would be the buy of the year if you got that low. And clean 5 waves up, clean 3 waves down, freakishly clean, right? But that being said, I do think that the near-term risk, again, this is a log chart, so you're not going to be able to really move the parallels very well, but I think the near-term risk is for one last flush. Now, here's what it looks like on the intraday chart. And even the other slope that we were following, here's the break, a new downtrend off the high. If this is in play, resistance near 44,900, the April low, 47. On the downside, there's that 38,777. Confluence with the 618 off the low. I tell you guys all the time, these are my favorite Fibonacci confluences. So it's a tough call. It's been a pretty meaningful washout, like I said already. You got so many hands, and all the headlines have already exhausted. So from a sentiment standpoint, I'd be cautious in trying to short this. But for those of you looking to fish, I think these are both levels. Pretty decent cast. Questions on Bitcoin? So Ethereum is doing a similar situation here. Here's the daily chart looks like there. That's at near-term trend support. So I haven't really been following this one quite as closely, but that formation has still been the same one that we've been working with essentially since last year. Basic low, high, low. Here's the 25% parallel support. If we break this, the ideal scenario, just like Bitcoin, a little bit of draw lower. 200-day moving average comes in at 25.90s. Slope support, your 23.30s. On this one, to correct or to complete a correctionary stance, right there, 200-day moving average, 100% extension. Keep an eye on that. Okay, that is everything that's on my list. Guys, let me know if you have any other questions or trade setups you would like to review. The only thing I didn't cover that we've been following in the reports, guys, is Kiwi. I don't like what this thing's doing. I'm just kind of thrown off. So I'll just give you a quick update on our last update for Kiwi. Wasn't too long ago. Here it is. Here's what this one looked like as we were heading into the close of last week. So the basic focus here was on this uptrend resistance and downtrend resistance. We were talking about the weekly opening range taking shape just below. The 236 was basically support into last week, right? That's at 70.84. That broke on Friday, and here's how it materialized. Tested as resistance, dropped even lower. We're straddling the monthly open. So what do you do with that, right? This is also your monthly opening range low. You're straddling that too. What do you do with that? All things held constant, this looks like a bearish trade still, 69.89. That doesn't jive too well with kind of getting the dollar exhaustion, which is why I'm more prone to look at the other majors, but they're the levels. Like, they haven't really changed, guys, from last week. We're basically trading right above that 50% retracement, but straddling the monthly open. So I don't like the range is so tight. I think this one finally gets a breakout as you get into FOMC maybe, or deeper in the week, but until it does, I think this one's just on the shelf for now. So not too much conviction here on Kiwi. All right. All right, if there are no other questions, we'll go ahead and wrap things up here. Quick reminder, I'll be on the Daily FX midweek strategy webinar tomorrow. So 9:30 Eastern will be that time. I hope to see you guys there. Otherwise, we'll pick things up back up here on Tuesday and Wednesday next week, on Tuesday and Thursday next week, rather. Till then, guys, best of luck trading through FOMC. Stay nimble. I'll see you guys tomorrow. Cheers.